Great. Today's section, we are starting with the question solving stage of consolidation. And I believe strongly that you come to the principles, how to consolidate. About 1 up to 8 standard steps when there was associates. Good. When there's associates. So basically, so we quickly look at a question called happy limited. That's the question we will look at for today. Today's section. That's ICAG MAY 2013. That's May 2013. So let's see. That is question number 12 in the material. Happy. Peace limited and happy. Okay, the number 2012 is that one is happy and joy. So there's happy and joy, and there's peace and happy. Oh. So May 2013, that one is plus. That one is peace. Happy limited. We'll look at that one. We start with our first question. The rest will now be scanning through questions year by year. Right after the first question, the remaining one is scanning through questions year by year. Okay, so we have managed as in May 2013. Peace and what happy. So go through the requirement as usual, rough or right. You read the requirement first and set it on. Let's go to the requirement. So let's see. Prepare a consolidated statement of financial position of Peace Limited Group as of the 3rd December 2013 for 20 months. Let's go to the story. Usually, consolidation, the footnote start from the top. There's a few information about the acquisition story. So let's start from there to know the full story or the full footnote. So it goes like this. Peace Limited acquired 450,000 ordinary share of what Happy Limited on 1st of January 2011 for 1.54 million. Good. 1.54 million. Perfect. At that date, the balance on the retained earnings of Happy Limited was a credit of 140,000, and the balance of the capital surplus was a credit of 28,000. That's a good balance. The statement of financial position of Peace and Happy Limited as of the 3rd December 2012 is as follows. Now, the acquisition is 1st January 2011. This is not what a mid-year. So, and we are going for the 3rd December 2012. So, how many years ago? 2 years ago, so 2011 and 2012. So you have what you call a full year consolidation or 2 years consolidation. Let's see. Let's go to the next one. Additional information. The investment in shares in the statement of financial position of Peace Limited consists of investments in Happy Limited at a cost, and investment in what? Joy. The investment in Joy constitutes 10% of the total capital of the investee entity. Now, what is the issue here? The investment in Joy consists of what? 10% of the total capital. So what's the name given to this? Using the accounting boundary. So the accounting boundary. So is it a mere investment or is it an associate? Looking at this, that's Joy. Joy become an associate. That's it range from 2019, 22, 49, 0 to 19 comes a mere investment, or 0 to 9. So that is. So in short, we are going to consolidate this. I'm not going to consolidate this. So this will be a mere investment. A mere investment. Okay, so let's start again. Now, the fair value of the plant of Happy was 200 million, so 200,000 in excess of its current amount after 1st January 2011. That is the acquisition date, right? You know, we said that you acquire fair value of net assets, you don't acquire book value. Why? Book value is subject to manipulation, so you acquire what? Fair value. So, but unfortunately, the financial statement prepared against what the book value. So we need to do what we call fair value adjustments in our net assets calculation. Fine. This plant is to be depreciated for 5 years from acquisition date on straight line basis with no residual value. Happy Limited has not reflected this adjustment in its financial statement. That's a good example. So that's the fair value adjustment, which will create what we call either additional depreciation or excess depreciation. Note 3. Peace Limited sold a plant to Happy Limited on 3rd January 2012 for 96,000. The plant had a cost of 100,000 in January 2011 and had a current amount of 18,000 on January 2012. The plant is to depreciate over its estimated remaining life. Remaining useful life of 4 years. Good. Now, this is what we call PUP, unrealized profit. So, according to the intra group, the one that we went through in the previous sections, the intra group. We have not gone through, kindly use the previous lecture videos to go through the intra group. Friends online, show me posting some videos on the page, right? Try to put them one after the other. What was the intra group? Discuss everything about how to go by these issues. Now here, anytime there was a sale between members, when there's a sale between members, to create what we call unrealized profit, if the goods are still in what inventory, or the item that they trade in is still inventory. That is all. So in short, I'll give you the steps. You have inventory, you can have PPE. So they can transfer goods or they can transfer what? PPE. Each of them will have a different accounting treatment. So if it is PPE, in this case, step 1. First step, eliminate the profit. So step 1, calculate the profit and then eliminate it. First step, calculate the profit and do eliminate the profit. How do you eliminate the profit? Because you can't sell to yourself and make profit or loss. If it's a loss, you kindly eliminate it because you can't sell to yourself and make loss. How we get it? Good. So after calculating the profit or loss, by comparing what the proceeds minus the current amount, treatment. What about this profit is? Let's go down. Who made the profit? If it is the parent, parent profit must what? Go down. If it is subsidiary, subsidiary's profit must what? Go down. So in short, subtract from the seller's profit. Then second, you subtract from where? Your PPE. So PPE must go down by that amount. That is the first section. Then don't end it there. Go to number 2, step 2. Now, because you saw the item at the profit, depreciation will also be what? Distorted. So let's adjust the depreciation. If you sell it at the profit, it will create what you call excess depreciation. The person will charge depreciation more by that amount. How do you get it? So you charge depreciation more. So it means that calculate what we call excess depreciation. Excess depreciation. How do you calculate the excess depreciation? Is if I take the profit made, excess depreciation is equal to the profit made. So take the profit rate divided by the number of years remaining to give what we call the excess depreciation. Again, eliminate the excess depreciation. How do you eliminate excess depreciation? First, who have charged the excess depreciation? The 2 entries. Number 1, who have charged the excess depreciation? The person that have the PPE in possession, he has charged the excess depreciation. Who? So the buyer. Locate the buyer, and then go and add it back to the buyer's profit. Add to the buyer's profit. I am using buyer because it's not the only that the parent will sell or subsidiary will sell. So add it to the buyer's profit. Whatever the profit is, if it is parent, add it to be retained earnings. If it is subsidiary, add it to the net assets at the report. B, add it back to the PP. Add it to PP. That is all. We are done. Add it to PP. Vertical. Add it to PP. So, that is the end of. That's all. So anytime you go to the exams, there is PP disposal between group members. That is the treatment that we look at. Let's quickly move on to the next footnote. In this case, how do we get a profit? How do we get the current amount? So we sold that plant to Happy on 3rd January 2012. So after 2012, what's the current amount? For 96. The current value after 2004 is 8, right? So he has made a profit of about 16,000 automatically. Good. Good. So here the profit is what? 16,000. Because take the current amount at the date of what? Sale. The current amount at the date of sale is what? 18. And the current amount of 80,000 unit first 4. So 80,000. So they said a profit of about 16 automatically. Reverse the 16. Who made a sale? Peace. So go to group retained earnings, subtract from group retained earnings. Second, subtract from PPE on the face of your balance sheet. Second, and you go to the second stage. Second stage, eliminate the excess depreciation. After the excess depreciation, from the date of sale, how many years remain? 4 years. So divide 16,000 by 4. You know what? 4. And then how many years? So from the date of sale, you sold it first in 2012, right? Good. So 4,000 goes in there, and they are going to revert the excess depreciation. Who have charged the depreciation? To be what? Happy. So Happy have charged the excess depreciation. The Happy's profit should go down. That's net asset. Second, add back to what? Add back to the PP. So in short, Happy's profit should be added. So you add 4,000 to Happy's profit, add 4,000 to the PP, and that is all. Okay. Okay. And look for this so boost to Happy Limited at the price of what? 25,000 on 29th December 2001. So for 29th December, I'm sure all the goods are still there, which were not received by Happy Limited until 10th January 2013. This limited calculate selling price at a markup of what? 25% on what? Cost. Good. So when I say markup, you should have answered the question there. You are aware. When I say cost, you should have answered the markup. So you need one. Good. So that is markup. The first, you can't sell to yourself and make profit. If you are selling between related parties, we call it transfer, not a sale. When you mention sale, that means there's a profit motive. When you mention transfer, there's no profit motive. That's called transfer pricing. So you need to get the profit and eliminate what the profit loading. One, from the seller's profit. Two, and then take it off from where? Inventory, and that is all. That is unrealized profit on what? Inventory. Unrealized profit on inventory. Thank God this one have all the two at the same time. Let's continue with it. Now note 5. A major customer of Happy Limited with an outstanding balance of 20,000 went into receivership just prior to the end of the reporting period. It is unlikely that any part of the outstanding balance will be received. Happy Limited financial accountant has forgotten to adjust for this. So what do? This is what? A bad debt. So you need to make a provision for the bad debt. It's not written off. That write this one off. 2 entries, then that's all. Number 1, subtract from the receivable. So receivable should go down by what? 20. Number 2, subtract it from Happy's profit. Who is Happy? Subsidiary. So less from the net asset at what? At reported. That is all. Net asset at what? At reported. Less it from net assets at reported. Basically. The next good look. It is the policy of the group. Good. The accounting treatment for the bad debt will be first, we should write it off by subtracting from where the receivable. So the group receivable should go down by what? 20. And the second, it's an expense to the company in question, which is what? Happy. So where is Happy? Who is Happy? Happy is a subsidiary. So its profit should go down. And subsidiary profit is in where? Net asset. Subsidiary profit is in where? Net asset. That is all. Good. So let's see. So you will subtract it from where? Net assets. That's the second treatment. And that is all. It is the policy of the group to value non-controlling interest at a proportionate share of what? Net assets of the subsidiary. Here, if I want to voice the case, I'll set it like this. It is the policy of the group to value non-controlling interest at proportionate share of the fair value of the identifiable net asset. That is, it just voice the case. Fair value of what? Identifiable net assets. If you see this, once there's what? Net assets there, it is what? Proportionate investment or partial goodwill. This goodwill is of what? The parent. Goodwill is of what? The parent. Our next question that we will discuss also, we should go on what? Fair value, so that you have the two. Because we only have 2 sections. Yeah. Then that is all. Number 7. Peace Limited undertakes annual review of goodwill impairment. At the 3rd December 2012, an impairment review suggests that an impairment of 400 was identified in respect of what's Happy Limited. So it has been impaired by what? 400. And that becomes an impairment. So impairment is an expense. So automatically we charge it against what? The parent. It's an expense to who? The investor. The parent. It's not an expense to who? The subsidiary. Subsidiary have not done anything, so it's an expense to the parent. You must go to parent form and then we move it from there. Parent take picture of the impairment. Now this impairment is not borne by parent alone. We're not going to give the NCI some of the impairment. No. Why? Because this is what for process investment and the good rules for only the parent. So if there's any like loss or the impairment of the parent. That is all. Why do we do this? Right after reading through the question like this, we scan to the financial position. Scanning to the financial position, pay maximum attention to the following. Number 1, when you see the word investment and investment in subsidiary. First item, property plant and administration. And this is investment here, right? They say investment in what? Yes. Pay maximum attention. They can tell you investment. So when they say investment there, when you see investment like this, it has different meaning. Number 1. Number 2, you can also see investment in the mentioned subsidiary. Number 3, you also see investment in subsidiary and other investment. Now, when you see investment in subsidiary like this, don't touch it or don't consolidate it. The rest, touch it. When you see the word investment or investment in subsidiary and other investment, that one bring it. The only one that you're not supposed to touch is what? The investment in subsidiary. When I mentioned the guy in the investment in happy get it. However, if you want to critics for the examiner, don't worry. If it is investment in subsidiary and you're not supposed to touch it, right? Don't worry, touch it. So right here, investment in what? Sub. If the figure is 80, open the bracket. Say 80 minus what? 80. Put the answer here, dash or 0. Anticipation for creation of what? Fixed. So that is it. Okay. So now we are done. So we can start the question. So right after the requirement of the footnote, we scan through them, and then we start again. So let's see. The investment in shares, so we are consolidated. Current assets. Inventories, the trade is not. Current account of what? Happy. Happy is the figure there is 75. Go and check the current liability. If you see current account under fish, the amount is what? 50. As that has no balance, right? The difference is as a result of what? Goods in what? Transit. The difference is as a result of what? Goods in transit. There was a particular person that they sold some goods. They did not receive it until the year end, 35,000. That is note 3. That's note 4. That's goods in transit. How do you treat goods in transit? So basically, that is it. Now let's continue. Cash and cash equivalent. That one, we consolidate them. We go to total assets. Empty. Set the capital. We pick only what? The parent. That is what? Piece. We don't consolidate what? The equity of what? The sum. Capital surplus. And then retained earnings. All of them pick for the parent. but we have a way of bringing them on the face like this. We go to return earnings, you have a good good return earnings. Then you go to the non-current liability. Again, you consolidate the mortgage loan, trade payable, you consolidate it, and then the current account. If you see current account on the financial position, it represents the amount that they owe by themselves. So if you owe each other, it must be recorded in what current account. That is all. But the next question we solve, or some of the question, it will be added to the normal payable and receivable. That's a very difficult one. If they add it to normal payable, the treatment is not different from what you see here. It's the same treatment. So if you want to subtract, just that of the receivable and payable. Let's start. Let's set it on. So first, I'll go straight. The three protocols. The three protocols. So the three protocols. First, the name of the company. I'll start from there. Now, the name of the company, just pick the parent name and add the word group to it. So parent name and add the word group to it, and that's all. So who's the parent here? Peace, right? So right, peace group. Peace group. So that is the first thing that we need to do. Second, the requirement. The requirement is consolidated statement of financial position. Statement of financial position as at 31st December 2012. Agreed. Yeah, the years are not striking. And basically, this is our first question. So I do not to pick questions that are a bit complicated. So right from this, then we pick the complicated ones. So join us when I do the complicated questions. Okay. Write the reporting currency in here. Check whether we create traders. The traders. So let's also create the traders for them. Good. Now, it is about financial position. Let's do first before you forget about it. Let's do first before you start the work. Let's go over here. Okay. That's the first you have to write. If you don't write it and you don't provide any space for it, by the time you come back, there's no space for it again. Right. Second, move the question paper. And now we copy. Check first. For financial position, whether it is a mid-year or it's a full year or 20 years or just 1 month, you consolidate what fully. You are like the first example that we saw on consolidation. The day that we acquired the guy, we consolidate the balance sheet and we took full figures. Agreed. Good. So pick all the items one after the other. If you pick parent owned plus subsidiary, and this within 5 minutes, maximum of 5, minimum of 3, you should be able to finish this. And leave spaces for some selected areas. When I reach there, I'll let you know. So first, let's go. You can open that. So I'll go to PP, right? PP is 6720 plus 820, right? So let's see. Right here, PP looks at that to open the bracket 6720 plus 820, right? I'll not close the brackets. I'll wait. Then the next section is investment investment in shares. I bring it in. Investment in shares. So investment in shares. I'll open a bracket. What's the figure? 2 or the and it's and now wait. Good. And I'll go to the next item. Now this question is able to go to all the footnotes successfully. None of the footnotes will raise additional non-current assets. Some of them you can see additional non-current assets coming from the footnote. This question don't have something like that. So in that case, you can move on. You can add and get a total of non-current assets. But sometimes it normally asks for you to leave 1 or 2 spaces in there for emergency. But because you've read through all these footnotes, you are sure that there's no additional non-current asset. Close it and move on. So close it there. The most important thing is the goodwill. Most of the goodwill is there before you close it. Then come to your total non-current assets. So let's come to current asset. Inventory. Yeah, we did some few minutes to be able to finish the class. Okay. So if you do have the question with you, I'll start moving fast. So inventories, we need to go in there. So let me quickly finish them up. And then we done. So to continue, inventory will be that's of 360 plus 170. We go to trade receivable. Trade receivable. We have this 370 to 30, right? Then we go to current account of happy. I'll not consolidate it. And we provide workings to show how the current account will look like. I'll not consolidate the current account because you can't owe yourself. That is it. Then I'll move on to cash and cash equivalents. So cash and cash. But in events you want plenty ticks or more ticks. If you bring it, make sure that the rate there must be eliminated. Perform workings to show how you eliminate them. So that is it. So cash and cash equivalents. I'll also open a bracket, which is 15 and 10. So 15 plus 10. Okay, so that is the first thing around 2. Then I'll move on to the next section. That is all for current assets, right? And when you get the question, there's nothing in the footnote that will create what additional current assets. So therefore, we are done with the current assets. But if you did this one before going to the footnote, that is only to provide some spaces for additional assets that may arise from the footnote. So here I will underline them, and that's all for my total assets. And I'll go to the next section, equity and liabilities. So equity. Let's start from equity. So equity, I start with stated capital. In this particular person, the stated capital does not have any issue. Pick only the parent. Here, there's no share exchange or share for share in this particular person. So I'm free to record this in the final answer. So stated capital, only the parent, 5,000. How we get it? Only the parent, 5,000. Good. Okay, so basically that is it. The next item on the list. Over here, I'll make an alternative presentation. Good. And I'll give you the best approach or the best practice. The next item on the list is the capital surplus, right? So right here, the group one. So it should be group capital surplus. There might be a working for it. And then the next one is what? Retained earnings, right? It should be group retained earnings. Just add retained earnings to it. Just add group to it. Retained earnings. There might be a workings for it. So we'll do that. Or alternatively, if you go to the equity side, even though there's capital surplus in there, you can dodge that examiner. Do that like this. Equity, write the equity down. Go to the capital. That considered capital goes straight to do what? Retained earnings. That is all. So that considered capital go to group what? Retained earnings. Even there's capital surplus. Good. But this is the best or the best approach. Good. But this is alternative. It means that the capital surplus will be what? Congested in a group retained earnings. And this is the best approach, this section. Okay. Now we know the two for you. All of them, the answer is the same. The final answer should be the same. Good. Then that is that for the group retained earnings. Then when you are done, you add all this. Good. You add all this, then you add the total answer, then add NCI to it. So non-controlling interest. Non-controlling what? Interest. NCI. At reporting so much. Aggregate. It is also correct. Alternatively, you can put the NCI together with the equity, then sum them up. The reason is this. Now the NCI, they are the other net assets that belong to other people. So that's why we must classify it on its own. How we get it? NCI needs to be classified on its own because it represents on our balance sheet what others owe, which does not amount to control. They are interest. So somebody's interest, I don't need to add it to my interest. I might show it on its own, even though the total interest is in there. So that's why normally we put it on its own, basically. Okay. So let's see. So right from here, then we move on to the next section. I'll do it at the other end here. Then we move on with the game. That almost the tail end. This you need to do it a bit fast. So continuation. Right from this, I'll find the total. So let's assume that the total is here. Then I move on to the next item, non-current liability. So non-current liability. Mortgage loan. Open a bracket. A mortgage loan, we have 3,250. So 3,200 plus 50. This one, there's no note that affected because it didn't say anything. If you go to the footnote, nothing was said about the mortgage. So I can put it in the 3,250 average. Good. Those that nothing affected, put them in. And that is all. You go to current liabilities. So current liabilities. With the current liabilities, the first on the list is what? Trade payable. So trade payable. Now, trade payable, I'll open a bracket And then 670 plus 270, right? 670 plus 270. So this is not conclusive. Nothing was said about it. Therefore, the nominal separated the current account from the trade payable. So the current account has been separated, and nothing was said about it. Good. So basically, that is it. Nothing was said about a trade payable. So I can also push them in. Those that there's no footnotes affecting it, can we push them in? Don't finish everything before you're going to push them in. At least it will help you to finish the game quickly. So as you add these two together, I should get to 940, right? Good. If there's any adjustment, we will do it. The next item is what? Current account of peace. We don't consolidate that. At the end of the day, they put all together. They had first they added all the liabilities. So if I should end here, I can even get a total liability without even touching anything from the footnote. I can get total liability, which is equal to these two answers. That's the total liability. So let's add up these two. 490. And then I'll go to equity and what? Liability. So I'm missing how consolidation can be. It's not touch anything in the footnote, but it starts covering. Okay, so that is it. Then we start with the workings. Rather unfortunate that I'll clean this board. But before I'll clean the board, make sure that you have all this in, so that when I prepare the workings, you go and then put them in. The workings that we need to present, the first goodwill, to areas that we need workings, goodwill. And we need workings for group retained earnings, NCI, and the group reserves, like the group capital surplus. Group what? Capital surplus. Good. And second, in fact, that's all the area that we need to do workings. The rest are adjustments, adding something to it, cancel something from it, and that is all. So kindly make sure that you have this template there. When I do the workings, and then I'll ask you to go and put it there, and then you put it there. I don't believe you want to system nicely smaller. I wish I have a expansion board or bigger board where I can start the working somewhere, so that the board will not permit me to do that. So I might clean this side, but this side I've done it already. So I'll clean this side and do the workings in here, and then you put them in. Let's start. The first working in consolidation when there's a financial position is the what? The group what? Structure. So the group structure. So we need to start with the group structure. The group structure have 3 sections. You need to go by all of them. So I'll start working on them and then we move on. Okay. So I want to clear this side more and start the workings in there. I hope you have your own there. So let's start again. And I'm going to look at actual. So I'm saying that consolidation is not something that is difficult. It should be a very interesting area for us. So workings, first one, third examiner. Workings number 1A, group structure. As someone also call it group structure. Okay, so group structure, that's the workings number 1A. Write the parent name here. Who's the parent? Peace. Write parent name here. And then write a subsidiary name on top. Who's the subsidiary? Happy, right? So Happy is a subsidiary. So write a parent name to here. How many shares acquired? Do the workings. Let's go. How many shares acquired? So Peach acquired 450,000 ordinary shares. Let's go to the balance sheet. So the capital. In fact, if I'm the hard copy, put into bracket 1 Ghana cedi. So the share price is 1 cedi. Now, so 450,000 out of what 600 shares, right? So what will be the percentage holding? You divide the 600 by what? 1 Ghana cedi to tell you the number of the percentage holding. So out of the 600, please apply 450. So your percentage holding will be, open the bracket, so they're working towards the 450,000 divided by what? 600 times what? 100 average. That working is you need to do it for us nicely. So 450 over 600 times 100. So give us okay, friends online. If your answers are ready, you can share. So 450. So that's 75% holding. You put it here for 90. And then if you have 75%, then you put NCI, non-controlling interest. That's the other remaining percentage. NCI. Okay. Now there's any that is little shade taking it off. So take note. NCI is what? 25%. Don't forget, all of them give us what? 100%. If there's associate, you bring it in. But this one, joy. Joy is what? A mere investment. Because we said that from 0 up to what? 19 is a mere what? Mere investment. Those people, they don't gonna make noise. And then we have from 20 to what? 49 becomes what? An associate. Then we have exactly 50. We call it joint arrangement or joint venture or joint operation, depending on the type. And we have from 50, between 50 and what? 100, we have what? Control. And that's the subsidy. That's the accounting money. You need to take care of it. So here, if I write joy, here, I'll put 10% here. Have you seen? Okay, I'll put 10% there. I also put NCR of 90% here. I put NCR 90% there. I'm aiming confused. No. Why? Because you now don't even have control. And then you have classified somebody as non-controlling interest. You yourself, you don't have control. And that person have 90, and you're calling that person non-controlling interest. Is that fair? No. So don't try. Associate don't have NCI. You don't have control. So you can't classify someone as well as NCI. That's the first one. I'll be clearing them. B, tell us effective date of what acquisition. Okay. If the share price stated in the first end is, let's say, 2 cedis, so to be, we will divide before we get these 600,000 shares. So the 600 cedis divided by what? The 2 cedis. Now give us 300 what? Shares. So there's it will be 300 shares. If it's 50 pesos, do the same thing. 50 pesos becomes 0.5, and that becomes 1,200 average. Perfect. Okay. So let's take note of that. Now let's continue with the effective date of what? Acquisition or control. Effective date of acquisition or effective date of control. What's the acquisition date? First of what? January 2011. That is all. The next one is period of consolidation. How long is the period of consolidation? Like, what is the consolidation period? So, consolidation period or period of consolidation. That would be In fact, since we acquired Happy 2 years ago, so we do what we call full consolidation. So full year consolidation. That is full year consolidation or 2 years. 2 years of consolidation, because this balance sheet take cumulative. Take note, balance sheet or the financial position, if we move it from the date of acquisition up to the reporting period. Unlike P&L or the profit and loss, that one is for the period, it's for that year. And that one cannot move from where? Acquisition date to now, no. So for balance sheet, we can say 2 years consolidation from the date of acquisition up to today, or full year of consolidation. Then you move on to the rest. Okay. So I'm done with the first workings. That is first working. Let's go to the two. So two will be the cost of what consideration. And this we're saying, thank God I don't have unit one, right? So cost of consideration. That's the note two. So note two, cost of consideration. Let the examiner, it is given to us, which is equal to 450,000, right? Agreed. The cost of consideration was given. The third examiner is given to pick it up. How much did the piece pay? We paid 1,540. 1,540. So it should be 1,540. 1,540,000. So it's like, so that is it. It is given. Go to workings number 3. Or here you can also replace here by the intra-group. Workings number 2 can replace the intra-group adjustment. But usually I do that one last and bring the cost of consideration 3. Okay, so let's see. Net asset. Working number 3 will be net asset. Good. That should be the first sentence. Should be the first on top of the financial statement. The first sentence. Usually it will be in the acquisition story. The first line on top of the balance sheet. Good. But unfortunately, last certain exam question that you wrote, it was in the footnote, the first footnote. The acquisition story was in the first footnote. Usually, the acquisition story is on top of the financial statement. It doesn't matter where the acquisition note will be. I can also put the acquisition note at the last footnote. Yes. Then we move on like that. Okay, so net asset at what? On net asset of the subsidiary. Okay, if you know the subsidiaries, they mention it. First online. This side is not all that visible. So let me, I'll not write that side. I'll not write that side. All right, here. Net asset of, if you know the name of the subsidiary, why not? Write it there for us, okay? But it's inside though. Wow. It's inside. Okay, so but I wrote net asset position there. Net asset of a subsidiary. Here the subsidiary is what? Happy, right? So write happy here for us, okay? Happy. Or you can also write subsidiary. Subsidiary. Then in market 2B, we have at what? Acquisition. Then we have at reporting. At acquisition, we have at reporting, and then we have what? Post acquisition. Post acquisition, basically. Don't forget the reporting currency, $3. Don't forget them. Now, where do you start from? Where do you start from? First thing that you do is this. You start from the share capital. The net assets is the same as what? The equity item. Net of your asset, the net total asset is the same as what? The equity item. Let's share capital of the subsidiary. So share capital. So that's the ordinary share capital, which is 600, right? From the statement, at reporting 600. Have you seen? I wrote that one first. At reporting is 600. And there's an assumption that since acquisition or in the footnote, they don't inform us that at acquisition, the subsidiary of what issue shares. So it means that the same figure was the one that was there at what? At acquisition. That's why most often we put the same figure there. That's the assumption. So if you put note inside, telling us that, oh, after acquisition, they're happy, issued additional shares at this, it will change the total capital. So, post will be this minus this, reporting minus acquisition, dash. Let's go to the next item in the equity. So, pick the equity item. Now, when you pick the equity item, well, there we have capital surplus. The capital surplus figure there is 40. So when you see the acquisition, go to where the acquisition stories are, they'll give it to us there. At that date, the balance of the retained earnings of happy was credit of what 140, and the balance of what capital surplus was 28. The capital surplus is 28, retained earnings is what 140. But I want the 28. So capital surplus at acquisition is what 28,006. Now this 28 is $3, right? So we can write what 28. Here's the 28. Then second, the one at reporting, the one in the balance sheet, which is 40, right? The post is what? The difference. That will be 22. This minus this. 40 minus 28. So, and that will give us 4. That's the post acquisition. 40 minus 28. Basically. Then we continue again to retain earnings. Retained earnings. We're told that at acquisition is what? 140,000. Let's go. 140,000. Yes, it's. Then let's go and then pick the one at reporting. Retained earnings at reporting is 220, right? So 220. What will be the post acquisition? Reporting minus what? At acquisition. And that'll give us so it's 80. Okay. Then basically we are done with the first side, the easier side, left with the adjustment. So anytime there's what adjustment, we need to adjust this net asset. That's all. The issue is this. The issue is this. Always we acquire what? The fair value of what? The net asset. We don't acquire the book value. Why? Because the book value, due to accounting, subjective accounting policy, it might probably be changed. So we don't acquire. So let's go in for fair value adjustment. So fair value adjustment. So fair value adjustment. First and always, let's go to the question and see if you can get the fair value adjustment. The plans of happy was 200 million in excess of its current value. Where you are 200 million. 2 of its current value. as of the 1st January 2011, that's the acquisition period. The plant is depreciated over what, 5 years from the acquisition date. So the fair value gain of what, 200. So kindly go in here, let examine plants, right here plants, and put 200 at what? At acquisition. There's not necessarily something there that I didn't finish. They said this has not been what? Recorded. Let me read it. Happy Limited has not reflected this adjustment in its financial statements. Good. Meaning that it has not been accounted for the fair value adjustment. So we need to account for it. It means that if we should bring it at reporting to. Yes, you have not reflect this in the financial statement given to you in the question, and that's at the reporting figure. How do you get this? Good. So in short, if that is not there, if not recorded it, still, if they have taken into account, they will inform us that, oh, happy as what? Taking into account this fair value adjustment. In that situation, don't bring it to what? At reporting. At reporting must be what? Dash. If the guy has what reflected this adjustment, at reporting must be that because he has recorded it already. Don't do double counting. Good. So in a situation where you have not recorded it, kindly bring it 200. It again, if it's a loss, put in bracket. And then you have to do what? Dash in the post-acquisition period. That's all. Now, don't rest. Any figure at all, any word, figure that you pick from the footnote to the reporting figures immediately send to the financial position. This one affect plan, right? So add it to 50, let's go 50 plus 200. That's all. Make sure that you do the double entry 1, 2, 1, 2, 1, 2, 1, 2 in that order to finish everything. Don't finish the entire question before you start posting. So anywhere you get to, in fact, even if you have treated one note, you are done fully, and the 2 ticks, all of them are yours. So that's all. Usually, the fair value normally creates fair value adjustment. Sorry. The fair valuation creates what you call fair value adjustment, and fair value adjustment creates what you call additional or excess depreciation. So we need to calculate what you call additional depreciation. Because they have not used the fair value, their depreciation is a bit lesser than the actual, because they should have used the fair value, which is more than the book value by what? 200. So tell the examiner additional what? Depreciation, or just write depreciation. Just depreciation, you're fine. Calculate the depreciation for me. How do you calculate the depreciation? Tell the examiner, Mr. Examiner, the depreciation will be like this. The gain itself divided by what? The remaining useful life of what? 5 years. If not 3 years, 4 years, to be what? 5 years. Good. And because we are going for financial position, balance sheet, what we have to do is this. Multiply by the period of what? Consolidation, 2 solid what? Years. You know, financial position take cumulative effect from the date of acquisition up to what? Now. Yes, from the date of what? Acquisition up to now, we take cumulative effect. So take note from the start. If it's the P&L or profit and loss, just 1 year. Because for the period, just 1 year, and we charge report because of those, and then that is all. Okay, so what we get after this calculation? That is 80. Good. For space, can we copy the workings? I'll take it off. 80 and 80. But this 80 should come at what? At reporting. Put it in bracket. It's an additional what? Depreciation. And depreciation reduce our profit. Basically, depreciation reduce our profit. So put the 80 here, and then minus 80 minus 0 will give us, so minus 80. at post-acquisition period, basically. Okay, so that is. Now, immediately, any figure at all that you place in the net asset that is coming from the footnote, what do? Go to the face, go and put it there. So the same PP, subtract what 80 from the PP, and we get it. Don't finish before. So by the time you treat, like you go to the last workings, by done with everything. The last working should let you finish everything. So after the last work, what do? You close all the accounts and put the final answer in. Okay. Let's continue again. So that's the additional depreciation. That is all. Now, in short, if the fair value gain or if the fair value adjustment result again, then it will create what? Additional depreciation. So if it's again, the depreciation subtract. If it's a loss, depreciation add. It's a reverse. If you get a loss, depreciation, what do? You add. If you get again, depreciation, what do? You subtract. That's the secret. That's all. Okay. Let's see something. There's another footnote in here. Go to note 5. We are treating the easy one. A major customer of who? Happy Limited. Note 5. A major customer of Happy Limited with an outstanding balance of what? 20,000 went into what? Went into receivership. Just prior to what? The end of the reporting period. It is unlikely that any part of the outstanding balance, any part, the entire amount, will be received. Happy Limited financial accountant has forgotten to adjust this. What do? It must be written off. So the two treatment. First, it must be separated from where? The trade receivable. Now we get it. So let's go. Trade receivable, go on the face. Trade minus what? 40. At the same time, it's an expense to who? Happy. So Happy's profit must gone down by what? This figure. What is Happy's profit? Happy's profit is net asset. All the time, the subsidiary profit is where? Net asset. So if you want to charge something against the subsidiary profit, go to where? Net asset. It ends there. But come here and tell the examiner. Mr. Examiner, there was something. Call it bad debt. 20,000, right? Sorry. 20,000. So bad debt dash. Put it at what? At reporting. And the same figure will come at the post. That is all. Okay. Then we go to, you ask yourself, do you have provision for unrealized profits? Provision for what? Unrealized profits. Provision for unrealized profit. Do you have some in the question? And then that is all. Provision for unrealized profit. So check. Provision for unrealized profit will result in two ways. Transfer of inventory at a profit and transfer of PPE at a profit. In most cases, by who? Subsidiary. So let's go. First of all, go to the note 3 and then note 4. That's where we can get it from. Now for note 4, Peace Limited sold. So it's a parent that sold to the subsidiary. So this will not affect what the subsidiary's profit. Usually the person that made the sale who made what? The unrealized profit. So his profit must go down. That is all. So note 4 might not affect what? Happy. Good news. Let's go to note 3. Note 3 is the transfer of what? Of asset at a profit. PPE at a profit. In that case, because Happy is a receiver, he will depreciate it at a profit. So we need to reverse the extra depreciation. That's the second side. So let's go there. So Peace Limited sold a plant to Happy Limited on February 2012 for what? 96,000. The plant had cost 100,000 in January 2011. Don't care. And had a carrying amount of what? 80,000 as of what? January 2012. So that means there's a profit of what? 16,000 immediately. So this profit should be eliminated. So first, let's eliminate the profit. Who made a sale? Parent. So go to parent profit and reduce it by the profit. Parent profit is as what? Group retained earnings, right? And that's it. We'll go to that workings. So I'll hold on. Second, take it from where? PPE. So let PPE go down by what? 16. The profit loading. PPE should go down by what? 16. By the profit what? Loading. Now let's still go to where? The parent what? In fact, if you remember, do it too. Don't say when I go and do it from there before I come and do it you. Well, I remember, I'll do it. But by the time I get there, they'll tell me that 15 minutes or somewhere. I'll put it here, I'll end it here. If I don't end it there, it's okay. It's far better than losing the two from both sides. Good. Now, there's a second item. If you sell PPE, two items, A and B. First one, the profit loading, eliminate it, and then the excess depreciation. Excess depreciation. So now let's calculate the excess depreciation. The excess depreciation will be calculated from the date of the sale to the reporting period. That one is not from the date of acquisition, it's from the date of what? Sale. When did the sale take place? From that side up to when? Up to the reporting period. So let's go and check when the sale took place. So the sale took place 1st January 2012. The 1st January 2012. 1st January 2012. So that means from that side, that we have to start calculating what the asset depreciation after reporting period. How many years? 1. Good. So even though it has given us 2011 information, we're not going to pay that one. So the estimated remaining life will be what? 4 years. Okay, so it should be, if you want to calculate the excess depreciation first, it should be the profit divided by what? The remaining useful life. So the profit of 16 divided by what? 4. How we get it? That becomes the excess depreciation, basically. Now, 2 entries. Who has charged this depreciation? The holder or the buyer? Who is the buyer? The subsidiary. So the subsidiary have charged this depreciation in excess of what? 4,000. So where is subsidiary's profit? Net assets. So let's go and revert this. He has said depreciation more by what? By 4,000. Let's reduce it. So say the examiner, excess depreciation. And do the working 16,000. So it will be 16 divided by 4, right? Because the rate ratio is 16 over 4. And now give us 4. Here we are adding back. Why are we adding back? He has charged it more because he bought the item at a higher amount because of the profit loading. So he put it in and put 4 to here. That is all. Put it in and put 4 in here. Okay. At the end of the day, we are done. Then immediately, any figure place here must go where? On the face. So this one is depreciation. That means add 4 to our PP again. And like that, everything step by step. If you should wait and be doing this at the time, you step yourself complete. As well as I'm putting it in the 2 entry, then you are getting it like that. So that is it. Okay. So at the end of the day, we are done with the net asset computation. Make sure that your net asset is correct. To give you better advantage if your net asset is correct. Everything that affects the subsidiary's profit should pay toward the net assets except impairment. Impairment does not pay toward subsidiary's profits. So basically, so you are done. Let's balance the net assets and then move on to the next stage of the computation. The next stage. The next stage Can you give me the total? So at acquisition, at reporting, and post, the total. At acquisition, at reporting, and post acquisition, the total. Please, if you are getting me the total for that of the post, don't add it up. Don't add it up to it. Maybe add from the 80. I'll explain why we are not taking the 12. The reason is this. I'll not take the 12 because I've calculated the capital surplus on its own on the face. So the capital surplus, I have disclosed it on the face of the consolidation. I don't need to add it again to the retained earnings calculation to the post-acquisition changes in the net asset. The shortcut approach, where that one don't show the capital surplus, we merge it in what? In the retained earnings or the change in the net assets. So if you merge it here and add all, that means if you are adding everything here, then don't come and then add those, the capital surplus. The alternative that I provided, that's better. So here is 968 that's at the position, right? So net asset at acquisition is 968. Okay, so after reporting will be 464. At reporting, 464. 464. 464. Then post will be 84. Negative, right? Or positive. 464, 964. Negative. Okay, so it's 964. It's 964. Okay, so 964. 16. Positive. We are not adding the yes. Positive. Okay, so minus 16. Yes. So negative 16. Good. So that is it. Minus 16. Perfect. Kindly copy these ones. I'll pick these ones. If I need at reporting, I will need this figure. Number 1, number 2, number 3. This one 16, negative 16. Number 3 and number 4. So kindly make sure that when I mention them, you give them to me. Okay, let's go to the next workings. We call it almighty good. Wow. So goodwill is our workings number 4, right after the net asset, because the workings 2 is the cost of consideration or cost of control. Working 3 is the net asset. So if you know these two, we can find the goodwill. So let's see how best we can for the goodwill. Goodwill. The goodwill, there are 2 types. We have what? The fair value or the full goodwill method. And then the second type is for partial goodwill or the proportionate interest of the fair value of the identifiable net asset. Identifiable net asset, basically. Okay, so let's go. Goodwill. Okay, number 4. Goodwill. Good. Well. In the brackets, I'm using net asset method or proportionate interest method. Proportionate interest method or partial goodwill. That example now, this one the goodwill of the parent only. Goodwill of who? The parent. Goodwill of the parent. We start by saying cost of consideration. What's the cost of consideration? So let's read the thousands here. Cost of consideration happen to be 1540. Once you know the cost of consideration, immediately check I'm going to explain this one under working number 2. Right after getting the cost of consideration, check the question. Whether in the non-current asset you see investment or you see investment in subsidiary. Over here they say what? Investment in what? Shares. We don't consolidate the amount paid by parent to acquire who? The subsidiary. We don't consolidate it. So, and that figure is inside this. What do you do? Take it off. So minus 154. 15540, right? How do you get it? So take it off. And then you add them because we don't consolidate any amount paid by the parent to acquire what the subsidiary as an asset on the face like this. No, that is what we are going to use to calculate the goodwill. So it is in the goodwill calculation, it must not reflect again, other than you what double counting. The goodwill will be on the balance sheet as a non-current asset, and you recording the cost or the amount to amount to what the double counting, the amount paid. So that is the second. There is the partial method, just less the net assets, parent share of net assets or at acquisition. So parent share. So P's share of what? P's share of net asset at acquisition. Open a bracket. What is the net asset at acquisition? Net asset at acquisition. 968. So parents having 75% so times 968. That's the parent share. His share will be 75% of 968. And I'll give us something like 726. So 726. Take it off, and that is a good row. And that is a good row. 814. Now this good row, that examiner, we call it good row at what? Reporting. Good row at reporting. Now take note of this. If you go to the exams and then sometimes the question will be on profit and loss, P&L, but the initial part will require you to calculate what the goodwill first. And now we will check the last word. Examiner will goodwill at the date of acquisition. If you get here, earn it. That's all. Don't continue again. Even there's impairment, even there's what impairment, the examiner has instructed you to calculate the goodwill at what? At acquisition. And that one is just this one. Let's what? Impairment. Goodwill. So I will do that reporting. Say it again. But goodwill at what? At acquisition. So goodwill at acquisition, not as reporting. That's goodwill at acquisition. So at the date of acquisition, the amount of goodwill transfer. Goodwill refers to the excess of purchase consideration over the net asset acquired. Excess of what? Purchase consideration over the net asset acquired. We can also define goodwill as what? Invisible assets. Assets that you pay for but they're not on the balance sheet. That's goodwill. What is impairment? Impairment is 100. So therefore, we get 414 as what? Goodwill at what? Reporting. Okay. So know when you should subtract impairment from goodwill and know when you should subtract impairment from goodwill. Usually, if the question is P&L, you actually calculate the goodwill as what? At acquisition, unless otherwise states at reporting. Yeah, that was goodwill. Immediately go, locate him and put him there. Now come here on the face, goodwill is here. Then examiner, working sum what? 4. Goodwill. Let's put in 414, right? Okay, so can you put your own in 414? Just that my own is not that visible. Let me do something in here. 414. Good. 414. Okay. We are going to the next workings. Workings number 5. Group retained earnings and other reserves. Group what? Retained earnings and what? Other reserves. Group retained earnings and other reserves. That's the next working. Group retained earnings and other reserves. Let's have group retained earnings. Okay, that one too. Can I take this section off and then start doing that one there? On the take this section off. Now this impairment, we'll do it again. Okay, before I do this, let me perform the alternative treatment for goodwill. How you can make it as an alternative? The alternative is that I do that one here, or a little bit here. Alternative calculation for goodwill. Start by saying, if it is partial, start by saying cost of consideration. It is 1540. That examiner, NCI. If NCI share of what? The net asset at acquisition. NCI is what? Share of the net assets at acquisition. So that will be 25% of what? The net assets. So 25% of 968, right? That will be 240. Add it. This one gives us what we call total consideration transfer to acquire the subsidiary. So 1782. Good. That's the total consideration transfer. Then examiner. Let the net asset at acquisition. Net asset at acquisition will be 968. Left all from it. She give us the goodwill at acquisition. 814. Then your impairment continue. The rest of the story continue. 814. That is alternative. You select any of this and then you move on with it. Stick to one approach and then you are fine. Okay, so let's go to the next working. Working number 5. Group retained earnings. Sorry, I finished. Group retained earnings. Group retained earnings and group what? Reserves. So there's a reserve here, capital surplus, so group retained earnings. These are very question, that's why I'm taking time like that. Next one, I'll be fast. Group retained earnings. Now, when you start with the group retained earnings, here, all of the parents, group retained earnings, that's working number 5. Sorry, okay, 5. All of the parents, what's the parent? Mention his name. Peace, all right, the peace is the head of what? The group. Is a parent, mention his name. Now, when make his retained earnings at reporting, his full retained earnings at what? At reporting. So, peace retained earnings at reporting B. Let's go, peace, where's the retained earnings at reporting? Peace retained earnings at reporting. It's a 1210. Perfect. 1210. I can see 140 here. I'm not agreeing. That one is for sorry, or for that one is for happy. Okay, so 1210. Perfect. Okay, and let's go. Then happy. Pick your share of happy's post-acquisition changes in the net assets. Share of what? Post-acquisition changes in what? Net assets. Right here, happy. By happy, take your share. Open a bracket. Take the post-acquisition. It was negative, right? So take 75% of what? Negative 16. Agree. So take 75% of negative 16. If it is a profit, you add. If it's a loss, you subtract. So 75% times minus 16, you get something like So 12 and put it in bracket. We are subtracting. Because our percentage, the group holding in Happy's was 75. We are taking our share of Happy's profits since the date of acquisition up to now. This is a balance sheet. Balance sheet was cumulative effect from the date of acquisition up to now. So that is it. So basically, we should do it this way. Then, in fact, there was Joy. We had 10% holding in Joy, which is a mere investment. They are not paying any interest or dividends, so we move like that. If there's maybe interest that they pay, then we will take our interest or dividend. There's nothing like that, so we move on. Now, is there any other item that will affect fees? Number one, the PUP on the PPE. Fees sold plants to who? To that of Happy and earning a profit of what? 16. This PPE is still within the group. You cannot sell something to yourself and make what? Profit. That is it. So therefore, must be better. So right here, unrealized profit. Unrealized profit of what? 16. And we have to subtract it. Unrealized profit. So that means I have completed the 16 here. Agreed. Again, there was unrealized profit in the person. If I go that, I'm recording the easy ones. Impairment, there's impairment, it's so easy. Record those that does not need any calculation, any workings first, before you go and then tackle those that need what? Workings. And then that if you go and tackle those that would workings and then they knock you down, if you left the easy ones and then you are following the difficult ones, no, it's not like that. Even military, they go to war, they attack the weakest person first and beat the person and give them vim. Before they go and beat what? The strongest people. You go and attack the strongest person and the person probably kill you. But so let's record impairment first, okay? I'm doing the easy one. By the time examiner realize I'm done. Impairment is on the right. Charge all to fees because I really want to call the proportionate interest method. Proportionate interest method. Proportionate what? Interest method. Now, in proportionate interest method, the goodwill is only for who? Parent. So, if the enjoyment is for the parent, and if there's any loss, the parent must also keep quiet and bear all. But if the goodwill is full goodwill, then comparison of what? Goodwill of the parent plus the goodwill of what? The NCI. So if there's any loss, it must contribute to their percentage holding. Good. So that's all. Now let's go and calculate the heartbeats. Let's about 2 footnotes, then we are done with the entire question. Let's go. Let's go to note 3. Peace sold, no, note 4. Peace sold goods to Happy Limited at the price of what? 25,000 on 29 December. Almost the last day. How can this person receive the goods? Why is closing his year account? So definitely we will not even add it to it. What if these companies are not trading within the same vicinity? It's far. What if they are trading in different sections of the country, which will take place more than 72 hours before we reach the other section? That is it. So peace. Happy will not receive these goods, which were not received by Happy Limited until what? 3rd January, because they want this financial statement given to us at what? December. So that is it. 2013. Peace Limited calculate the selling price at a markup of 25% on cost. So this 25%, 25,000 is what? The selling price, and then it's a markup of 25. Now let me explain the treatment of PUP of inventory, the accounting treatment of PUP in inventory. That is the treatment. First, we are saying that you don't need to sell among yourself at what? At a profit. We're not saying don't sell among yourself. We are saying if you sell, don't sell at a what? At a profit. Call it a transfer, don't call it a sale. If you have something your brother asks you, don't sell to your brother. Say, come and take it. I mean, saying that's a transfer. So you have a vehicle, write small, then give it to your brother. Brother also write small. Don't sell to the brother. That is what you are talking about in what? The book. Okay, perfect. There's a question here. So at what point do we treat unrealized profit inwards the net assets? You only treat unrealized profit in the net assets if the subsidiary is the seller. If the subsidiary is what? The seller. In these two cases, all of them, the parent is what? The seller. That is why the unrealized profit never affected the subsidiary's profit. I hope you get it very well. Good. Now, always the person who made a sale who earn what? The unrealized profit, which need to be reversed. So whoever earned that amount, you have to reverse in that person's profit. For instance, anywhere you tie a goat, that's the same place you untie the goat to. Good. Because you can't buy a shoe in Accra and go to Kumasi and go and exchange it there. You don't agree. So whoever made a sale has made a profit, and that person's profit should go down. Now let me walk you through these entries, and then we are done. First, what happened is this. The goose, in fact, this goose is in transit. It's a two-story altogether. The goose in transit at the same time intra-group sales. So let's go to workings number. I'll call this one. I'll go to workings number 6. Intra-group sales. Intra-group sales. So intra-group sales. Let me be down on top here, because I want you to get every aspect of intra-group sales. Now, when parent or the subsidiary sells to each other, so workings number 6. I'm not done with this one. I come back to intra-group sales. Okay. So first, calculate the unrealized profits on it. Whoever made that sale, reduce it. So unrealized profit on the sale. Unrealized profit. Third examiner is equal to the profit holding times the goods left in inventory. Goods what? Left in inventory. That is all. So if the buyer have been able to pass on the goods to an outsider or outside the group, that one you don't need to make any unrealized profit. How we get it? Good. That is all. Now, if we are doing profit and loss, P&L, the entire sales is what? Eliminated, because you can't sell to yourself. You can't sell to what? Yourself. So for P&L, we take it off. But for balance sheet, we say, okay, you can sell, but not at profit. That is it. So, in short, profit loading times the goods left in inventory. In this case, all the goods are in inventory because the guy has not even received the goods. Has not even received the goods. So all the goods are what? They are in inventory. So here will be 25,000. What's the profit loading? Markup or margin? Good. Here, there's no topic in financial reporting that should use markup or margin. But we use that one to also worry small. If it is markup, don't worry. Convert this one is selling price, and your markup is on cost. So convert it, and the percentage is what? So that examiner, it will be A over B plus A. That is, if it is what? Markup, and change it to what? Margin. So that is all. So 25 over what? 125. So 25 out of 125 times 25,000. That becomes the profit load. So in short, I write the unrealized profit. Unrealized profit. If you can do the workings, you open the bracket and do them without showing additional workings up there. Okay, so that is the unrealized profit. Oh, first one I saw it. The 25 is not 125 is not coming clear. There's 125 here. So that will give us 5,000. So that will be 5. So unrealized profit 5. We are subtracting. Yes, if you can do this, there's no need for working 6. If you read it, there's no need for working 6. If you can do this one here, no need for working 6. Okay. Now, who has the goods in inventory? The buyer. Here is Happy, right? Have you added Happy's inventory? Yes, you added Happy's inventory. Go there and take it off. Where is it? Inventory. So I'll come to inventory. I'll take 5 off. Then there's something. That's right. Yes, the profit loading. It's unrealized. It must reverse. Yes, unrealized profit. So one, the working we show unrealized profit on inventory, and one is on PP. So this one is on PP. Unrealized profit on PP. This one unrealized profit on what? On inventory. But there are 3 forms of unrealized profits. 1, inventory. 2, PP, transfer, and then 3. You can transfer inventory as PP. You can also transfer PP as inventory. Maybe if the parent sell cars and then the subsidiary does not deal with cars, and the parent sells some of these cars to the subsidiary, and the subsidiary going to use for administrative purposes. That's inventory what PP, and reverse is also true. So okay. Now let's see. So basically, that is all. Go to the phrase we subtracted it. Now let's do the last hard bit. There was goods in transit. So what is the goods in transit? How do you treat it in the books? Goods in transit. Now this goods, they've not received it. Anytime there's a goods in transit, please, it is the same as what cash in transit. Goods in transit and cash in what transit. In here, I'll do another workings again. So this one does establish another point again. This we are done. So you can add all and then send it to the face before we do the goods in transit. Then we are almost getting to the end. Goods in transit. So let's quickly look at it. But that's the last workings that we do. That's the end of the game. So 790, right? 93. So account book retail name is 793. 793. That is book retail 793. Then I'll go to the goods in transit. How do you treat goods in transit? The number 7, goods in transit. It's same treatment for cash in transit. Here, right? Who transferred the goods? Okay. Right? Parent here, peace, right? So, right? The parent company, peace, right? Happy here. Do a Chinese bundle. And Happy, so in peace book, we call it a current account. Is that the receivable payable? Good. So he received. Right there, receivable. The figure is what? 75. In happy book, it will be under what? Payable, and amount is what? 50. The difference is what? The goods in what? Transit. The difference is the goods in transit. Now, anytime there's a goods in transit or cash in transit, first assumption, assume that the recipient company has done what? Received the goods. Assume that the recipient company has received the goods. Now, what's your careful? If the recipient, who's the recipient company? Happy. So if Happy has received the goods, you are there and then you acquire goods on credit. That's the meaning. If acquire goods on what? Credit. So Happy have acquired goods on credit. What are the two entries? Number one, debit the goods or the inventory. So go and add the inventory. So plus 25. Number two, what's the next treatment? Happy will owe, right? Increase the Happy payable. So plus 25. Happy is what? Payable. That is all. Because Happy will owe by what? 25. I don't really let it what 75. It might be what? Eliminated. That is all. That is all no consolidated. How to get? If there's no balance, you cannot what? Eliminate it. And this you have to do it for the examiner. They score you. In some situation, the examiner will add these figures to the trade receivable and trade payable. In that case, come and do it on the face. How to get it? If it is cash in transit, it's the same thing. Cash. Assume that the receiving company has received what? The money. They have received it, two entry. Add it to your cash. Second, subtract it from where? Subtract it from the receiving company. Subtract from the receivable. And then that's all. And that's the end of the day. So the last working for the day is the group reserves. And then that's the end. Then we just add them together. Let's go to group reserves. Hey, let me do NCI, right? Okay, I'll do NCI and then go to group reserve. NCI is just one. NCI. So that's working number 8, right? NCI at reporting. NCI together will go to balance. We're using what you call the proportion to interest method. Start by saying that NCI share of net asset at reporting. So net asset at what? Sorry, at acquisition. That reporting the shortcut. I'll do that one later. I don't normally do the shortcut first. So the NCI share will be what? 25% times 968. And that will give us 242 average. 242. Good. Then add changes in post-acquisition retained earnings. So changes in post-acquisition change. The post-acquisition results. Open a bracket. It's negative 16, right? Times 25. That will give us 4, right? The negative 4. Good. The reserves. The capital surplus. And then write here capital surplus. The capital surplus to tell the examiner. The difference, the real of rent times 25%. How we get it? Why 12? The capital surplus movement was what? Was 12. Then we find what? The subsidiary share, which is 25%. What do you get? So put them together, and that's all. So that should give us 3. So that's the end of what? The NCI reporting. Yes, 12 times 25%, NCI percentage. Take NCI share of what? The changes. And then let's add all. So that will give us 241, right? So NCI should be 241. Why? NCI, show yourself. Yes, 241. The last one is the group, the capital surplus. Take that of the parents. And then add the parent share of the changes. And that is all. Take that of all the parents and add the changes to it. And then that's all. Let me down again. For this NCI, there's a shortcut. The shortcut is that just find NCI share of what? The net asset at reporting. In that case, kindly add a 12 to the net asset at reporting and find what 25% on it. It will give you the same as 241. So the net asset at reporting, add the 12, we didn't capture the 12. So add the 12 to it and just find 25%. It will give you the same answer as 241. Good. Now let's do the last workings of the day. Set exam now, workings on my mind. Group reserves. That's a group capital surplus. Parent, what's the parent own? Parent own is what? 75. Agreed. Parent capital surplus. Parent capital surplus. Let's see from the question. Parent, where's your capital surplus? Parent capital surplus is what? 200, right? Okay, so parent own is 200. But let's write peace. You know what the parent is called? Peace. You know the name. Then write happy. Happy's own, take your share. The changes was 12, right? Parent will take 75%. That's 3/4. 3/4 of 12. That should give us 9. I don't know if it will be 209. That examiner. Capital surplus will be 209. But group capital surplus 209. Now we are done. Add everything together and balance everything. And that's the end of the game. You add all, and then balance. Everything will balance in here. Can you put those figures together for us? See that. Unfortunately, for this is how far the good Lord bring us. And let's go end here and kindly move with us when we are solving the complex question. These are first questions, so that's why it's a bit empty. The next one will be in that order until we go to the complex section. Great. Have a nice day. If you have any question, can you ask? If there's no question to you, let me. And kindly subscribe if you have not done that. Have a nice evening.